The cost of capital is one of the drivers of abnormal operating income in the economic profit framework. Have you wondered what really drives the weighted average cost of capital? In this video, we look at how we include risk, the cost of capital, as one of the drivers of economic profit. We know that abnormal operating income equals the difference between a firm's operating income after tax and its weighted average cost of capital times its net operating assets. This can be restated as abnormal operating income equals return on net operating assets minus the weighted average cost of capital, all times net operating assets, where return on net operating assets equals operating income divided by net operating assets. In restating a firm's financial statements, we separate a firm's operating and financial activities and identify these key accounting measures of the enterprise of a firm: operating income after tax, OI, and net operating assets, NOA. The missing item is the weighted average cost of capital. When focusing on a firm itself rather than on the equity of a firm, we need to focus on the weighted average cost of capital, which is the opportunity cost of the capital required to fund a firm's operations, not the opportunity cost of the capital required to fund its equity. The operations of each firm will have their own unique risks. A firm will face potential risks such as risks in its markets from the actions of competitors, customers, and suppliers. Risks from changes in technology, changes in customer tastes, changes in demographics, risks due to weather, general economic factors, exchange rate movements, changes in commodity prices, risks from changes in tax and regulatory rules and requirements, and many other types of risks. Businesses face risk and uncertainty in their operations every day. Indeed, in business there are risks at every turn, lurking under every rock. The risks of a business relative to other investment opportunities determine the return that someone would require investing in the operations of a firm. This is a firm's cost of capital for its operations, or the cost of capital for the firm. That is, its weighted average cost of capital. It is usually called the weighted average cost of capital because it can be expressed as the weighted average of the cost of capital for equity and the cost of capital for debt. This will be a familiar concept for those who have studied finance. VE is the market value of a firm's equity in period zero. VD is the market value of a firm's debt in period zero. And VF is the market value of a firm's operations in period zero. Weighted average cost of capital, ROE, and ROD are related to each other by a simple expression based on the proportions of the market value of a firm represented by the market value of its equity and by the market value of its debt, or in other words, by a measure of its gearing or financial structure. The cost of capital for a firm's operations, the weighted average cost of capital, is the proportion of the market value of a firm represented by the market value of its equity multiplied by its equity cost of capital, plus the proportion of the market value of a firm represented by the market value of its debt multiplied by its debt cost of capital. You will notice that both equity and debt are at market value, not at accounting or book values. For further information on focusing on the cost of capital for operations, the weighted average cost of capital, go back to Chapter 6, Section 6.1 in the study guide, and also review Focus on the Enterprise weekly questions. Also answer, write and rate questions on Focus on the Enterprise in Peerwise.